Hi, Greg Lewis, Metastock Software. You're about to watch one of the presentations from the 2017 Online Traders Summit. I know you're going to enjoy it. Before we begin, I want to tell you just a little bit about us here at Metastock. We've been in business for about 30 years. Metastock is about the most powerful platform you can get for the private trader anywhere. You can test, you can scan, you can forecast, you can customize to your heart's content. It's an amazing piece of trading technology. If you'd like to get a free extended trial of Metastock, I encourage you to go to metastock.com/traders-summit 3-for-1. That's metastock.com/traders-summit 3-for-1, or just click one of the links provided, and you can get 3 months of Metastock for the price of one. That's an amazing deal. I encourage you to do so. I know you won't regret it. Please enjoy the presentation and successful trading.
So I got to throw out the disclosure. We're running a class here in Scottsdale. I currently live now in Scottsdale, Arizona. I had enough of Chicago, but if you've been there during February to understand that. So I realized I just grabbed a laptop, and it doesn't have PowerPoint, so I'm not on my laptop and not on my home computer here. I'm on a separate system, so I'm going to be scrolling through slides. It's all right though. It's going to all work out. It's going to be good.
All right, I'm gonna let you run with it.
All right, so fantastic. Welcome everybody. I think you guys have been here for a few hours. Hopefully you're not too burned out. I think we're really gonna change a lot of the tone for many of the other presenters. So if you guys are familiar with me, great. If you're not, I'll go through. Today I'm gonna be talking about a little bit about the skills you need to survive volatility. And of course, what have you seen lately? Absolutely no volatility. So, why is this guy coming on here talking about volatility? Well, we haven't seen any for many years. Really what this session is going to be about today is about understanding your risk. If you don't understand your risk, you're going to find out very quickly that you can't succeed in this business. So I'm going to look at this from a vastly different perspective. So bear with me as I'm scrolling through my slides today. Risk disclosure. So tell you about TheoTrade in just a moment, but we're not financial advisors or a broker-dealer. The reason I mentioned that I'm not a financial advisor, broker-dealer is a copyright disclaimer. This is a little bit about me. Again, my name is Don Kaufman. I'm the co-founder here of TheoTrade. I've had a 19-year trading career, which started in Chicago, and I started trading in Chicago in 1998 at the Chicago Board Options Exchange. They made me a derivatives risk manager. A short time after that, I was invited, this is actually 2000-2001 timeframe, I was invited to a startup firm called thinkorswim. Some of you guys are aware of it, some of you guys, it's a brokerage firm, right? So I was, I think, employee number 12 of thinkorswim. I was there when we took the company public. I went on and ran the education at TD Ameritrade and their 7 million clients for about 5 years before finally hanging it up. So one of the original founders of thinkorswim turned around and said, you got to get back into this, and let's build something together. And here we are at TheoTrade. So what is a TheoTrade? We're educational, but we specialize in education for options, futures, stocks. All of our educators, all of our instructors have 15 years minimum experience, many with a lot of decades. And the first thing that we put up here is we're here to help you mitigate risks. I know everybody's like, I want to make money, I want to make money. Yeah, well, you can make a ton of money in the market and give it all back at one time, and that's what most people ultimately do. So a little bit about who we have here at TheoTrade. TheoTrade is not just Don Kaufman. It sounds, great, oh, it's Don. But we have Doc Severson. Anybody here familiar with Doc? So stocks, options, technicals are his specialty. Doc has been in the industry a long time. Jeff Bierman. Jeff Bierman was actually the right-hand man. He was also the chief market technician for TD Ameritrade, which is a kind of a highly coveted position. His technical analysis skills basically ran that of 7 million clients. We have Steve Miller, 42-year veteran stock options futures trader, and of course Tony Rago to round out our crew. So we have 5 full-time instructors here at TheoTrade, and we're actually adding more right now. So we've got kind of a packed crew over here. And again, I always make the point, it's very important that people know that, you know, this isn't not about me. This is about building an educational firm that ultimately will suffice to be, you know, hey, we've got market technicians, we have option specialists, we've got Tony Rago on the futures side of things. Let's get started though on today's presentation here, risk and success. Hopefully everybody see the screen okay? Yeah, we doing good? You should see somebody vomiting outside of a Mac. Yeah? Okay, all right, just making sure. I like this. It's instant feedback. By the way, these are not rhetorical questions. You guys can jump in here anytime you want. Again, I think I'm going to have a vastly different, I guess, presentation than maybe you've seen today, and probably eat up the better part of an hour. The first thing I really stress to you is risk and success. How you handle your risk, okay, is it's just directly correlated to your success in the markets. Too much risk, you're going to panic, you're going to, you know, lose control, and continuously you're going to basically get rid of the positions at the worst possible time. So, but at least you're consistent with your panic. That statement, it's a bold statement, but that statement actually comes from respect to the, you know, I had the ability to not only be a trader, so I was a trader for 2 years in the professional side, and I've been a retail client now for the better part of 17 years. And even though I'm a retail client just like you, by the way, I have an account at a brokerage firm like everybody has to, right? You trade, yada, yada, yada. But the one ability that I had that you did not have, I watched order flow for 15 years of my career. What that basically means, I got to see what everybody did. You know, I worked at the single largest retail brokerage firm in the world, like meaning in terms of the numbers of trades that went through the system. And some of the stuff you learn, it's invaluable. And I just cannot stress that enough, is that learning curve and the amount of studies that we did on different accounts there. It was just phenomenal education for me running the education group of TD Ameritrade. So that's where that risk and success. Anyway, expect the unexpected. I know that that's kind of like an ironic statement, but plan for anything the markets can throw at you. Like, look at the markets differently for a second. Step back from, you know, and I don't want to poke fun at this, but step back from the MACDs, the Fibonacci's, the Bollinger Bands, stochastics, the Elliott Wave, or whatever else you're into for a second. Okay? With all due respect, step back from it. Trading is just a game of chess. It's one of the first things that was described to me. I worked for a very successful derivatives firm based originally in Chicago. And one of the first things they sat me down, I went to classes just like this, and they said, listen, it's a game of chess. We're going to talk a little bit about probabilities today. We're going to laugh. We're going to cry. We're going to figure out what our risk is. But a decent chess player can see their opponent's possible move and calculate probability, 4 to 5 moves into the future. Okay? I'm going to show you how to take this concept into the markets. Again, you may not know where the markets are going to go, but you can plan out every single possibility. Now, check your baggage at the door. Now, this is also a kind of a bold statement over there. Set aside any preconceived notions, what you think can happen in the markets. That's why I wanted to start with this, is everybody's like, it's low volatility. It's going to be low forever. Good. That's an opinion. Check it at the door. Volatility hits the markets, your risk has to be in check. Or you just die trying. It doesn't matter like how much money you make in the markets. Each and every one of you have to realize that's all well and good. But I can actually give you specific dates in history where I watched successful traders give it all back inside of a day. I mean, literally, I can there's marquee days. October 10th of 2008. That's one of the most marquee days in the entire market. I can tell you all the way back 2001. I originally traded in Yahoo back in like 98. When the stock got added to the S&P. These are like defining days in the market where people get infatuated. But this is about risk right now. Okay, put risk first. Prepare yourself for any event. How hard can it be? The markets can move up, down, or sideways, right? Again, good risk management starts with the perception that anything can and will occur. Now, it's reflection time in the markets. Have you ever had an individual trade that was going against you? Okay, and near the moment you bailed out, the markets turned around. Anybody? Anybody, anybody, anybody. Okay, think about that for a second. Have you ever had a position where it was literally, I'm looking at the Q&A over here, Come on, people. Admitting it's the first step. Cough it up. Cough it up. Okay. And everyone does what they call barfing up the trade at the worst possible time. By the way, that is a true trading term. Yes, if you've traded, again, you're going to know exactly what I'm referencing over here. Another area that I really want to hammer right before I actually teach you more about risk management and the way that the entire professional trading arena worries about risk management. But here's another dirty, dirty phrase. I can fix it. I know I can fix it. Fix is a really dirty word. Like, it's a very, very dirty word in trading. 15 years in the brokerage business, I'm totally like a cynic. Apparently, I can't, my spell check can't see cynic, but regarding good trades gone bad, anytime you're fixing a trade, you're just adding more risk to an already losing trade and racking up transaction costs. Now think about that for a second. Classically speaking, people are told, don't worry about it. Average down, fix this. If you trade some options over there, yada, yada, yada. Every fix amounts to, okay, two things. Every single fix amounts to two things. What's a fix? A fix for a trade. It's adding more risk, okay? Without an equivocation, I say this. You can't fix anything in the marketplace without adding more risk. If you do something, it has more risk, right? The other thing is more commissions. Okay, so why does everybody promote, I need to fix this? I don't know, because I can show you mathematically that fixing trades adds more risk to an already losing position. The irony of this, before I go any further, think about the irony of this entire idea. You're more willing to throw good capital into an already terrible trade, right? Good capital into a terrible trade. But when you actually make money, do you add to the winner? No. When you make money, you actually take it off. Do you think that's going to be mathematically viable for you in the long run? You'll press a loser, but you won't press a winner. You're a loser in the end. Okay? It's a mathematical certainty. That's the whole thing like about trading. It's like, yes, we can talk about, again, you know, different directional bias and MACDs and Fibonacci's and trying to pick up on market trends. But what's so much more important than that is that people miss the big overwhelming logic of trading. If you don't do smart things again and again, okay, you will lose money. It's a mathematical certainty. I mean, if you look at, there's something I call like the law of large occurrences. You have to look at things not as if you're going to do it one time, but if you're going to do it thousands of times. Sure, you can fix trades. The fix may even work, but the very notion of fixing a trade throws good capital after bad. It's fun stuff, right? Okay, cruising on over here. Now we're going to talk a little bit about expected moves. Your risk can only be controlled. It can only be like really, you have to ascertain what your risk is. You have to have some measure of expectation. Okay, so we're going to talk about expected moves. What do you expect? First step in risk management, know what to expect and know what the unexpected holds. What I'm referencing, okay, is probabilities in trading an expected move. So let's get started in this direction. All right, we having fun yet? Huh? Anybody? Okay. By the way, I love it. I'm sorry, I'm reading some of the comments in here. That is funny. You want a Scrabble game with that word. Except my spell check wasn't supposed to do that. All right, let's start with option pricing. Okay. How many of you do look at options? By the way, this is not going to be a big, long discussion on options. Not going to get into, listen, I trade stocks, options, futures. I'm an equal opportunity exploiter of products. I just don't care. In the end, if you could buy it and sell it, that's fine with me. But how many of you do trade some options? Anybody? You know, there's an interesting irony. The first person said, no, options are too risky. Okay. Once again, the irony of that is the options were originally developed as risk management tools. I mean, again, I'm not going to make this a big options thing, but if you've never really looked at options, options are like, it's a power saw. Okay. If you're going to build a house, you could build a house with a handsaw, but you'd be pretty exhausted. Or you could build a house with a power saw. If you don't know how to use a power saw, you're obviously going to lop off a couple of fingers. The same analogy is true of options. Options will be the quickest, fastest, safest like product to get where you want to go. But if you don't know how to use them, you will chop off your fingers. Okay. So the thing with options pricing is, do you trust pricing? There's now 15 exchanges and billions of dollars at risk. Okay. Option markets in liquid products have become relatively efficient. So for the most part, if you were to look at option markets, they are really, really efficient. So what do option markets tell you? Again, I actually don't want to hammer that you have to trade options, but for those of you that have never looked at an option before, I will make this argument. Success today, you will need to look at the option market, because what the option market is doing, well, we're going to find out right now. Okay, I will make an argument again. It doesn't matter whether you trade stocks, options, or futures. I'm going to get you to look at option markets in a vastly different way, not because you're going to trade it. Because I don't want to make an argument that I need to trade options. I'm not barking up that tree. But if you don't understand the product that you're trading, you're going to have a tough time. Option, they put a price tag on future risks of an underlying product. That's what option markets tell you. Okay, listen to what the option markets are saying. Listen to what risk is saying. Risk on any product translates into option pricing. When people think of an option price, what do they really think? All right, I could buy me a call, or I could buy me a put. But option markets, they just place a price tag on risk at some point in the future. Okay, that's really what the product is. Options, they speak volumes. Option pricing can actually be extrapolated into stock price movement. And that's exactly what we're going to do over here. How? We're going to extrapolate stock movement from the option prices themselves to understand how options can define future moves on a stock. We need to examine what's termed implied volatility. Okay? Don't let the word implied volatility really scare you. Okay? Because what can implied volatility do for you? And I'll look at a few live examples over here. So what can implied volatility? Implied volatility, I'm just going to give you the whole lowdown, and I'm even going to take you into some live examples. Is that okay with everybody? Let's say you have a stock, and you know what? I think I got a little drawing tool over here. Yeah, drawing tools. Here's a stock, and the stock is trading right smack at $100, right? What can the stock do? Stock can go up, stock can go down, right? Fantastic. A volatility is associated with every product that has options on it. Whether you look at Apple, whether you look at Google, whether you look at Amazon, yada, 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 there are options, okay? So if you look at Apple, and Apple right now has right around a 30% implied volatility. Like, what does that really mean, 30%? Like, what does 30% mean? Well, that's kind of what we're getting into over here, okay? That's, again, one of the most important things to understand over here is, what does that IV mean? So here's a stock at 100, and it has a 20% implied volatility. It means that that stock is capable of moving about up 20% or down 20% within approximately 1 year of time. By the way, you know what? I'll show where the 30% comes from. I'm going to go into a live trading application. We'll pull up some IVs, okay? Implied volatilities. So this implied volatility of 20%, it extrapolates into stock price movement. That basically means the 20% is equivalent to how far the stock is going to move. And it says the stock itself can move up 20% or down 20%. And it's supposed to stay in that range. And again, here's a big special number. It's supposed to stay in that range about 68% of the time. Now, where the 68% of the time come from, that's one standard deviation. Now, does that information help you? Maybe. Maybe. If you know a stock can only move up $20 or down $20, okay, it's a help to a degree. You kind of have a feel for the risk. But the first question is 68% of the time, what's going to happen to you up here, and then what's going to happen to you down here? The other, what? There's 16% up here, there's 16% down here, and you're like, oh. I mean, could you see a stock go from 100 all the way down to like, $5 in a week? Yeah, of course. Might be Equifax this next week, who knows? But of course that can happen in there. However, this is a great way to start to be able to gauge risk. Now, again, I'm going to go on a little bit more detailed, but I promise we're going to answer some questions, because this is kind of leads you down a rabbit hole and there ain't no coming back. Implied volatility and expected price moves. So what is implied volatility? Like, what does it delineate? Okay? And how can you really use it? Implied volatility justifies the option's current price. Whatever. I think that's like double talk in there, right? how can you use implied volatility in your day-to-day trading? Implied volatility can be extrapolated into stock price movement, or what is termed expected move. Now, as I kind of scroll forward, what that means is I can tell you if a stock is capable of moving up or down. And I can also tell you how far it can move within a given period of time with certain probabilities behind that. Right? It is. It's good stuff. Think about that. Now, expected move and probability. Now I'm going to show you, again, a couple of little screenshots in here. What expected move is, expected move defines a 1 standard deviation move in a given underlying. Therefore, there's a 68% probability of an underlying closing inside the expected move by a designated expiration. Expected move is what we call a probability of expiring. Now, I'm running through this, okay, but not everybody has expected move. Now, I'm just going to bring up a live app, okay, and I never, listen, I worked at a brokerage firm for 15 years. I never got to show my own account. I show my own account, P&L, everything now. It's kind of fun. Let's talk for a moment about these expected moves, and I'll make sure, absolutely sure, that you guys can see them. Let's just talk for a moment about them, because anybody that has access to options, you guys give me a stock. You give me a stock. Somebody mentioned Apple earlier. Oh, I've never heard of that one before. Okay, I got my Mac issued underwear on over here, people. I got my iPhone. I got my iPad. I do wear an Apple Watch because it's, I don't know, it's a watch. I don't use a Mac computer because I don't want to blow $2,000 and then spill coffee all over it. Anyway, it's so we'll bring up Apple, and I'm picking on Apple because they have a big announcement coming out next week. So let's start to talk a little bit more about Apple itself, and I'm going to use these fun little drawing tools again on here. So with Apple, let's choose a different pen color. Let's get crazy. Let's use purple. Purple pen. All right, so let's go to the pen. Over here on the right-hand side of my screen, okay, these are implied volatilities. First of all, where do they come from? Okay, am I pulling 31% out of thin air? Like, seriously, am I pulling 31% out of thin air? No, not pulling 31% out of thin air over there, okay? That 31%, what is it? It's derived from the options themselves. See, what an option actually does is it puts a price tag on risk in the future. That's it. Like, people think options are like weapons of mass destruction of financial markets. Yeah, well, really what they are, here's an option that has 6 days left. 6 days left to live. What an option really does, it's just handicapping the game 6 days out. What's the game? The game is the market. Doesn't matter if this is Apple. Who cares? AAPL. This is a couple of symbols, 6 days, and a volatility. Yada, yada, yada. That's all you need to know. Okay? Now, all the volatilities averaged together are 31%. 31%, that extrapolates to a $5.44 expected move. A $5.44 expected move. Now, wherever you might be trading, that's fine, okay? I'm not here to tell you got to open an account here, there, or anywhere, right? I mean, right over here is an expected move, and that's all well and good. But if you don't have that, I mean, a lot of trading applications do not have this number. Where could you actually find it? Every single one of you, if you have access to a brokerage firm, okay, erase all the drawings over here. If you have access to a brokerage firm, you can ultimately figure out this expected move. You want to know how to do it? Follow along with one easy step. Just use what's termed the at-the-money straddle. Okay? Add up these calls and these puts. There's the puts, there's the calls. Okay? Add up these calls with these puts. So all I did was add what's termed the at-the-money. Now, some of you don't speak option geek. I speak option geek, right? This is what we call the money. The money is the stock price. Go basically to the nearest strike price. What's a strike price? See these little monkeys? 52.5, 155, 155, or sorry, 157.50. Okay? Then we come up to 160. Go to whatever is like the closest. This one's like a coin toss away, right? So I went to the 1 57.5. I look at the puts. Everything on this side of the screen is puts. Everything on this side of the screen is calls. I just add these puts to these calls. I just did it on the bottom of the screen. That equals $5.09. It's almost the same as this like incredibly crazy calculation over here, which is the expected move. Just add the call and the put and equals $5.09. What does that do? What does that tell you? What it tells you is that's the expectation of stock price movement. Now, some people are going to back away. Remember, we started with this idea, erase all the drawings here. So we started with this idea, and people are like, well, can I trust that? I don't know. Can you? Can you really trust the prices you see on your screen? Let's go open and do something crazy like volume and open interest. Okay, this is the number of contracts that have been traded. Just with 6 days left. Look at this. There's 90,000 contracts open. You do realize that that's billions of dollars being bet on either side of these markets. I'm pretty sure these markets are ridiculously accurate. Why? Because if the option markets are wrong, then you got 91,000 contracts that's wrong. And if 91,000 contracts is wrong, then I don't want to be right. I mean, this stuff is so important. Okay? It's such an important concept in here that everybody seems to miss. And you're like, okay, so who cares, Don? You're telling me the stock can move $5 and change. What the hell am I going to do with that? And again, come back over here to the slide deck. If you don't have the expected move, you just use the at the money straddle. Okay? And I'll show you. Add the at the money call to the at the money put. It's exactly what I did. Kind of continuing on. Implied volatility opportunities. Now, let's start to understand this. Like, why does it matter? Okay? If you can extrapolate stock price movement, the option market is telling you what stock price is going to do. Now, I know a lot of people always have that question, like, how often is this stuff accurate? Does anybody want to know that? Anybody? Okay? Because we have answers for that. And the answer is it's incredibly accurate. Understanding volatility or expected move is a step in the right direction. Your understanding of these metrics, okay, can take our risk management to the next level. Let's explore implied volatility and expected moves on various products. Tesla, Facebook, SPX, Microsoft, Walmart, Google, okay? You know what? Let's actually go. Let's look at a few examples. I mean, have you ever thought of this before? If you understand stuff like implied volatility, let's go and, come on, backspace, okay? Let's go look at Walmart. Why do I want to look at Walmart? I don't know. I'm feeling special, okay? So we're going to go look at Walmart. If you look over to the right-hand side of the screen, all right, my mouse is feverishly moving on this, all right? What do we got? 17-18% implied volatility. Okay, it's Walmart. Now, the cool thing about implied volatility, before I go any further, forget about expected move, forget about anything for a second. 17%. Okay? What were some of the other things we were going to compare it to? Let's compare Walmart and Google. Do you think Walmart is riskier than Google? Do you think Walmart's riskier than Google? Come on. All right? Anybody? What's the riskier product, Walmart or Google? Because it's an interesting one. And again, all right, it's, Walmart, it's Google, okay? You laugh, you cry. By the way, Walmart, that place kills me. Kills me! Why, you might ask? I don't know. You go in there, and I don't go shopping very often. I try not to leave the house. But if you go to Walmart, and every single Walmart is required to have at least one naked child running around just in the diaper that's probably under the age of 2. It's the requirement of every Walmart, I think, in the entire world. Anyway, if you take a look at this, and boom, let's go look at Walmart. It's about 18% implied volatility. And then you start to look at stuff like Google. I'll pull up Google L, the same animal. Pull up something like Google. Google's volatility is actually slightly below Walmart. You think about how crazy that is. It's Walmart. Google is one of the biggest tech stocks out there. Tech is always thought of as being relatively volatile. I'm not trying to give you like a trick question over here, but you start looking at this and you have to start to shake your head and go, what the hell is going on? When Google is trading at a lower risk level than Walmart, and everybody assumes that Google is relatively volatile. Let's try another one over here. When I start to look at this stuff, you know, we look at something like Microsoft. Let's go look at Microsoft. Okay, so we'll quickly glance at Microsoft. Microsoft's volatility in the short duration here is actually lower than Walmart. And again, it's pretty shocking when you start looking at this stuff. And then, of course, everybody's like, well, what's Tesla doing? Okay, Tesla's really, really volatile. Okay, Tesla's 36% implied volatility. 36%. But you want to see something crazy? Look at the next 6 days. Tesla has a 33% volatility. And everybody thinks of Tesla as the wild child of the market. I want you to take a look at Apple again. Look at Apple right now. Apple basically, in the next few days, because Apple has an announcement, Apple's volatility is almost the same as Tesla. So right off the bat, we have a way that looking at implied volatility instantaneously helps you gauge risk from product to product to product to product. Okay? Because implied volatility is universal. And again, every time I do any sessions, all right, I want there to be like an immediate takeaway, like you know, when the market opens on Monday, that you can actually use this stuff. And you will, you know, some of you guys don't even look at options, but I want you to be able to look at marketplaces and say, hey, I'm starting to see what he's talking about. Like, this is crazy. Have you looked at Facebook? I don't know. Let's go look at it. Okay. Well, you know, what's a risky product out there? Go look at something like Facebook. Facebook apparently is not risky anymore. It has 20% implied volatility. And what you thought might have been risky, and we can go through every single symbol that you ever dreamed of, but what you thought was classically speaking so risky isn't nearly as risky as maybe you anticipated. All right? And again, I stress that. And somebody was talking about, you know, Microsoft's weekly chart. It's, you know, so I'm extracting anything, okay, from chart. Now, somebody mentioned NVIDIA. I like it. And again, we got built in a little bit of time over here to look at some products. So NVIDIA has about the same risk as Tesla. Okay, you want to see some wildly risky products because you assumed that these were high-risk products. By the way, historically speaking, 30% implied volatility is nothing. You want to see some riskier products? Go look at stuff called the VXX. People love this product, the VXX. This is one of the most dangerous products in the entire industry, bar none. Volatility products are some of the highest volatility that are out there. This is 70% implied volatility. So basically, you're trading something like the VXX, you're trading with your hair on fire. Do you realize if you traded one day, okay, you traded one day Google, and then the next day you traded VXX, that you're trading a product, okay, that's legitimately 4 times as risky. It's getting 4 times as risky. Like, how does that make you want to approach your risk? Right? For me, it says I'm going to probably allocate, what, 1/4 of the capital to something that has 4 times the risk. Most retail clients are never taught to think that way. Oh, all right, last one, I promise, but somebody mentioned Home Depot in here. Okay, Home Depot. What do we got? Home Depot, 21% implied volatility. Boy, that thing has gone up. I'm not pulling up a chart. Okay, I'm. You know what? Today I'm going to be the anti-chart type. Everybody had charts on here. I caught a couple of presentations before. I'm going the complete other direction. No charts. So those are some opportunities. Now we're going to talk about aggregating your risks, getting a grip on the reality of your risk. Okay, how big is your risk? Okay, what large risk you have. Next step, how much risk do you have on? You need to know within a few dollars, what's your total exposure to the markets within a given period? Do you know that? What I want you to be capable of answering today, this is just one simple question. What's your profit and loss potential in the next 30 days? Okay, some of you guys, listen, I know some of you guys trade intraday. This stuff can also be used on an intraday basis. Primarily, like I had to pick a direction here today, primarily this is for clientele that would be holding positions overnight. Okay, but for right now, I'm just going to use the next 30 days because I thought that was I guess the marquee in this. So what's your profit and loss potential for the next 30 days? You go out and buy a stock, you're short a stock. By the way, I don't care long, short. People, you want to see? Okay, look, I think I'm short enough. I'm short 3 S&P contracts, 3 NASDAQ futures, short a bunch of Microsoft, short a couple thousand deltas in the XLF. okay, yada, 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 and a partridge in a pear tree. I'm short a lot of crap right now. Why? Because I want to be. But you know what? I'm comfortable with my risk because I can answer this question. What's my profit and loss potential in the next 30 days? Let's take some action. First, look at your portfolio's value and estimate the total market exposure. Okay, this is going to require you to add together. Does anybody here have a 401k? If you have a 401k, good. IRA, yes. Mutual funds, sure. Taxable and margin accounts, absolutely. Total invested funds, sure. Okay. By the way, don't panic and have to take a couple of notes because we can get you this PowerPoint presentation after the fact. And this PowerPoint presentation is designed to literally walk you through every single step, okay, so that you can't mess this up. Like I wanted to give like real, again, useful information from day one. So add together whatever your 401k, IRA happens to be, and I'll kind of take you through that. Aggregating your portfolio value. Take all the products that you're long and or short and add up the total value. If you're using futures contracts, use the total contract value. One E-mini contract has a notional value, let's say, of 120,000. All I'm saying is add up everything you got. I'm going to take you through this exercise a couple of times. Index correlation. Select an index or an ETF product having the greatest correlation to your overall portfolio exposure. Don't overthink this entire thing. Most portfolios have a strong relationship with the S&P. So, okay, at this point, you know, you've listened to me here for 30 minutes and your head's spinning. So at this point, what do I really want you to be able to do? I want you to be able to go out there and say, here is my 401k, okay? My 401k is long stocks, and I got a couple of, you know, mutual funds in there, yada, yada, yada. But your 401k, let me go back to a pen. The 401k, what's in it? What's in it? How much capital? Let's say your 401k has $130,000 in it. Now, I'm just coming up, okay, with an absolute, you know, whatever, extraneous number. It's $130,000 in your 401k. And that $130,000 is invested in some type of fund. Now, today, the funds are always fun. Like, let's call it a 2050 fund. What does a 2050 fund mean? It means you're going to die probably before you ever see the end of that thing. No, it means you're supposed to retire like in 2050, which, oh boy, that's kind of far out in the future. But that's the way they're doing it, to kind of string people along. Like, hey, we told you, don't get out of it until 2050. That's why they call them that, because they're telling you don't get out of it until 2050. You're like, what happens if the market crashes that year? They go, then your butt's working another 3 years. That's the answer. Anyway, I always think when's the end of the long haul? 1 foot in the grave or both feet in the grave? So it's some 2050 fund. It's got 130,000 bucks in it. Those mutual funds correlate probably to the S&P 500. The SPY, the Q, the IWM could also be possible candidates, okay, where the larger portfolio exposure happens to be. Okay, so just bear with me as I take you through this, because you'll see, you have to kind of see it, you know, and I have to take you through this a few times before you see the value in what I'm kind of going through. You have a $130,000 portfolio, and it has a strong relationship to the S&P. So we're going to select the spiders. We're going to do this exercise in the spiders. Now, calculate your risk, okay? Divide your portfolio value by the ETF product selected. I'll give you an example. When I originally put this slide deck together, okay, we selected the spider, which was trading at 240. Let's just go over and look at the spiders real quick, okay? So SPY, SPY, enter. The spider right now is trading at 246, okay? Not too far off where I originally put this slide deck together. So it says the SPY is trading at 240. Let's say our portfolio is 194,000. Okay, listen, your portfolio could be next to nothing. It doesn't matter. I don't care if your portfolio is $5,000 or 5 million. This exercise, okay, will coincide nicely for either one of those. So if you take the $194,000 and divide it by 240, again, what's 240? That's the current share price. That's the current share price of the spiders. Take the $194,000 divided by 240. It equals 808. So your portfolio of, and again, let's just call it what it is. Your portfolio is always a mishmash, right? This portfolio right there is a mishmash. I mean, this doesn't even have to be. You could have something like Apple in the portfolio. You could have Google in the portfolio, a little bit of GE in the portfolio. Maybe you got some Goldman Sachs in the portfolio. These two haven't gone well. Okay, so let's say you're building a portfolio. This portfolio, whatever it is, okay, if you looked at Apple and Google and GE and Goldman Sachs, maybe throw a little like XOM in there. You throw all these together, that could equal $194,000, right? Just divide it by the price of the SPY. It equals the equivalency of about 808 shares of the SPY. So again, therefore, our portfolio is approximately 800 shares of the SPDR. It means that this Apple and Google and GE and Goldman Sachs and ExxonMobil or some mutual fund, this portfolio is an equivalency to about 800 shares. Okay, everything that you do in the marketplace, has some ETF or some product that has an equivalency to it, meaning that Apple doesn't just trade autonomously. Apple trades with a relationship to the SPDRs. Okay, Google trades with a relationship to the SPDRs. The SPDRs are the S&P. Everything has relationships. Okay, and your portfolio then has about 808 shares of the SPY risk. So now you recognize your aggregated risk. Now you're ready to calculate what your portfolio is likely to make or lose as the markets move. Okay, that's it. Using the product you selected, take a standard time frame of approximately 30 days and measure the expected move. Now let's go do it. Let's go into the SPDRs. Let's go about 30 days out in time, right? There just happens to be an option that's 32 days out in time. I don't care. I mean, like, listen, it doesn't matter to me. Let's go to the highlighter over here. Listen, there's the expected move right there. What is it? The expected move is right around $7. That's the expected move for approximately the next 30 days on the SPY. Everybody got it? Erase the drawings over here. Now, back to it. So, using the product you selected, take a standard time frame, approximately 30 days, and measure the expected move. Take the number of shares you're long or short and multiply this by the expected move. So, what was the number of shares we were long or short? 808. Okay? Let's do the math over there. Expected risk. Expected move is expected risk. Now, here's an example that I plotted for you. In our example, we're long the equivalency of 808 shares of the SPY. The SPY expected move for 30 days is approximately $6.42. Right there, right? Okay. Take the $6.42 and multiply it by the 800 shares. Why the 800 shares? Why are you multiplying it? Because it tells you the standard deviation of risk. Every trading firm on the planet, this is how they measure their risk. They literally go into the marketplace and they go, yo, what's the expected move? Guy says, $8. And he goes, fine. We're long, X amount of shares. What's our expected risk? If you can't answer that question, you fired. I mean, literally, like in the risk management side of the business, they'll can you immediately. Their deviation is $5,187. So you're like, what the hell? How'd you get that? Okay. How did we get $5,000? Because you have 800 shares of the SPDRs. Now the SPDRs, see, that's a distribution curve. The SPDRs, doesn't matter what you think the SPDRs are going to do. The SPDRs have the ability to move what? Up about $6 or down $6 according to the option world. Okay. And they're supposed to stay in that range. So if they move up $6 or down $6, you're the equivalency of 800 shares. That's going to be a P&L swing of $5,187. Now, can you answer this question? Are you comfortable with that? Do you want to make or lose? Do you want to make or lose $5,200? calculating the extremes too. I mean, so before we go any further, let's play Go Fish. If you know that you can lose $5,200 over the next 30 days, are you comfortable? If you can't answer yes immediately, guess what? You got too much risk on. You're going to get toasted. This isn't telling you that you're going to lose $5,200. Okay? This is going to tell you we are going to move in the range of $5,200. Okay? And you will do this. How many people here can honestly say that they've ever calculated their expected risk? Okay, how many people can honestly say they've ever calculated their expected risk before? It's okay, like, you know, nobody, oh yeah, okay. Some people, maybe, because we haven't actually taken this to the extreme yet, all right? This is the simple part of it. And I know if you're a little bit lost right now, you go through this 3 or 4 times, you'll get it. So this is your expected risk. Now, the expected risk, always base it. Forget, people use all different types of equations, like I use beta weighting, I use this. Forget all that crap. Use the expected move. It's the standard now, pretty much, in the last 3 to 5 years in market risk expectations. This is what the trading firms are using these days. Now you have to calculate the extremes. Let's clarify. With 808 equivalent shares of the SPDR, you're taking a 68% chance of seeing a $5,200 profit loss swing in the next 30 days. Now take this number and double it, now triple it. To account for less probable events, you must assume you could see the market move 3 times the expected move at least once per year. That's a big one. So for the most part, you take this expected move and you're supposed to triple it. That's a $19, okay, $19 expected move. Now take the $19 expected move times 808 shares. Can you handle $15,000 of risk inside of the next 30 days? Most people totally freak out. Why do you think? I started with people freak out at the worst possible times. It could be actually one of the best possible times. They freak out when the market makes the big unexpected move. If you can't swallow whatever the number is that you're looking at on the screen, which is $15,000 in my case, then you're too big. This is where people panic in their 401ks. Again, how does it feel? Ask yourself every single step of the way, am I comfortable? Am I comfortable? Am I comfortable with this level of risk? If the answer is no, lighten the load or learn to hedge. Okay, in risk management, you must never assume the market will go up or will go down. You just take the probability stance based on expected events and weigh that, okay, against your individual appetite for risk. It's big, really, really big, okay? Volatility odds and ends, additional considerations for volatile markets. Size matters. If you're used to trading at a 10 volatility, what's the first thing you should consider when volatility spikes? Okay? Higher volatility directly implies you're going to get more movement in individual stock or overall market. The right side is you're getting more bang for your buck. Cut trading size in accordance with increased movement in markets. If volatility doubles, you can literally half the size of your trades and still maintain, okay, profit and loss swings. I mean, again, this stuff, you know, whatever you might think about it, the bottom line is retail clients don't look at this, right? Listen, the buck stops here. I looked at your accounts for the past 15 years. Like, I know who makes money and who loses money, and people lose money not because they're wrong on the markets. It's not because they're wrong on the markets. They just don't know what their size is. They don't know if they can handle risk until the risk actually hits them. I mean, listen, it's literally like playing a game of chicken with the market. And when the market actually hits you, you know, you're like, oh, that hit me with a 20-pound sledgehammer and I'm pretty much knocked out of the game. I wasn't really expecting that. That can't ever happen to you. You know, you can't take the one big loss over there. Stop orders. Let's talk about stops for a second. Again, this whole section, additional considerations for volatility. Stop orders, they work all too well. Sure, stop orders work maybe too well. In periods of heavier volatility, you must consider the probability of being stopped out has greatly increased. Stop orders, if utilized, must be placed further away from the underlying instrument. Use expected move to help you determine viable placement for stop orders. You're like, what's that? Okay, the bottom line is this. Want to see something fun? Another use for these expected moves. Let's go over here to something like Apple. This is for even intraday traders. You have an Apple trade on for the next 6 days. Okay, this is 6-day stuff. Let's talk short term for just a second, because I trade in intraday, I trade, holding overnight. I mean, I showed you a bunch of positions, but this is just the next 6 days. The expected move again is $5.44. Did you know that if you use a stop, you have to put the stop outside the expected move? Why? Because if you put it inside the expected move, the probability of hitting the stop is all but assured. And if the probability of hitting the stop is all but assured, don't tell me you're going to make money, because you're going to get stopped out a huge amount of the time. There's metrics for this called probability of touching. Okay? If you have a 55% chance of touching, and again, this is not about an option trade, you have a 55% chance of touching 155. So if you do 100 trades, 55% of the time, you would have gotten stopped out early. Okay? Got to place the stops out further. Liquidity. Trade liquid markets. Bid-offer spreads are going to widen out, even the most liquid products, as we get volatile. You may not be able to get out. You got to think about that too. Markets get volatile, you may not be able to get out. Period. Never place yourself in a position of needing to get out. And yes, I'm talking about you, the iron condor sellers. I think I've never seen that one. For those of you that do trade some options, you do iron condors, you never have to need to get out. Okay? One of the last things over here, volatility crush. If you do trade options, okay, do not buy out of the money calls. It's a serious mistake, as it leaves you as exposed to volatility risk. If your intent is in buying options, use an 80 delta option or higher to avoid volatility. Don't get vol crushed. You've been warned. Use like vertical spreads where possible. All I'm trying to do, okay, in this presentation, get you to mitigate your risk. You got to learn to mitigate risk to survive as markets start to throw more volatility. Speaking of more volatility, we're throwing off all kinds of signs of it right now. It's just whether you're willing to read that and whether you're willing to accept it. Markets are becoming more volatile. So with that, and by the way, what delta? I know I'm running through it fast. Okay, I want to leave a little time for some Q&A over here. Use 80 delta or higher. See, one of the things that people do when the markets start tanking, I'll show you an example here. Let's go over here, throw a pen up. The market starts tanking, okay? So, I don't know, this could be Apple. The market starts to tank in Apple. There we go, we're drawing it tanking. And you go out here and you buy a call. Okay, the moment the market bounces up, if the market bounces up to your call, the IV, which is implied volatility, goes down. So when you buy a call looking for a bounce, the market does bounce, but the volatility gets sucked right out of the marketplace. It's called getting vol crushed. It's, rookie mistake. But I've watched this for 15 years, and people just like, I mean, the best thing is being on the other end of that phone call. They're like, I bought a call, the stock went up, and I still lost money. I go, oh, you got screwed in that one. That's not good at all. I go, you just got vol crushed. I mean, there's nothing else you can say. You got to know about this stuff. And if you're scared about this volatility crush, just use vertical spreads. I live on vertical spreads. It just mitigates all that volatility risk. So I'll take a couple of questions, and I'll also give, by the way, here at TheoTrade, we do things vastly differently. We do an evening video every single night. It's about 10 minutes long. The evening video goes to our members. We don't have like a special membership video. It goes to our members, goes to our non-members. All you have to do is go to TheoTrade.com. Just go to TheoTrade.com. That's it. TheoTrade, right? THEO trade.com. Enter your first name and your email address. That's it. Get instant access. We'll give you the nightly video. Okay. We've got an ebook that you guys can read through. We have tons and tons of free educational resources on here. Okay. If you like, and in terms of like, here's an options ebook. We have tutorials that we can take you through. Okay. Again, you name it, we've got it. And people ask like, well, what do we do? We have classes. We don't sell the classes really. Okay. Typically what we do at TheoTrade, it's pretty unique. For the most part, if you're a member, you get everything. And I'm not propositioning anybody on this, whatever. When I say when you're a member, you get everything, it's it's a membership where you can access to a chat room, access to classes, access to anything you want, access to all the instructors, access to the capability to be able to actually email the instructors for questions. And again, if you're into charts, I'm much more of a quantitative trader, but if you're into charts, we have Doc Severson, okay, we have Tony Rago, we have Jeff Bierman, all there to answer questions. So yeah, excellent. I'm glad that some people are actually tuning into the nightly videos. Seriously, tune into the nightly videos. Again, we're not here to pitch you anything. We want people to understand that it's risk first, reward second. I mean, that's the way to access the market. One of kind of the mantras that we use over here at TheoTrade, I'm just scrolling down, but one of the mantras we use here at TheoTrade, you know, if you as you start to like kind of click around the site, is we look at the marketplace, I think, vastly different. When I say the mantras, we look at trade logic first, your allocation second, and directional bias third. And don't let that throw you, okay? Again, we look at, and think about this, trade logic comes first. That means what kind of trade structure you're using. Secondly, we would look at how much you're allocating, and third, then we'll find direction in the marketplace. So again, just go to TheoTrade.com. You can enter your first name, your email address, and we'll get you access to the videos every evening over there. And again, I think I've got most of the questions kind of knocked out. I hope you guys enjoyed it. Again, I really try to give you something that I want you to be able to take it away. Like, I want you to be able to look at implied volatilities and say, oh man, I had no idea I was trading something this risky. Or the opposite, man, oh, this thing, I can handle more risk than that. You know, the other day I went out and I talked about a stock that I bought. Okay, and sometimes I start, again, stocks, options, futures. I went out though and I bought Ford the other day, and its volatility was only 22%. People were shocked. They're like, that stock's been getting just crushed lately. I don't have it set up. That stock's been getting crushed lately, but it's still only 22% volatility. It's not a lot of risk. So it allowed us to allocate a little bit more capital. So with that, I want to thank everybody here at Metastock for kind of having us on. Again, I got a lot of the questions answered. I got to run back. I've got a live group here of about 300 people here live in Scottsdale. So I'm going to go run back to the live presentation. And yes, I have had a lot of caffeine today. So by all means, feel free. And also, if you guys ever need to get a hold of me, or just go to support@TheoTrade, support@TheoTrade.com. Again, you can email us directly through the site over here. There's contact information right there. All of the emails are seen by all of our associates here at TheoTrade. So by all means, you just go to the support@TheoTrade.com. Our office now is located in Scottsdale, Arizona, because Chicago is no fun in February. Anyway, thanks everybody. I appreciate you having me here, and I'll turn it back over to Jeff and crew.
Great, thanks, Don. Appreciate it. Good job. Thanks for taking a break from your other presentation to do this one. No rest, right? Anyway, great to have you. A lot of really good comments. We enjoyed having you on here, and we'll see you definitely at the first one. The next one. Are you guys getting loopy? I'm a little loopy. Anyway, let's kind of get into the next one. Hope you guys are enjoying the event today. Hopefully it's helpful for you. I do want to do a real quick shout out to the people that have kind of signed up for Metastock already. So Pitchin, thank you. Rajiv, thank you. Apologies if I butcher any of your emails. Neville, thank you. Ken, Jack, Ricardo, Poe, Yoke, Robin, Jeremy, thanks for getting Metastock and getting set up. It has been busy today. I really appreciate everybody coming. I think it's been one of our best sessions that we've done. I do want to kind of remind you, next we have Rick Sadler up. We're going to talk a little bit about his add-on again. As well, we're doing a special today, though. $3.90. You can order Steve Bigelow's, Wendy Kirkland's, and Rick Sadler's, all of their add-ons. Probably three of the best add-ons we've got. I'll just say that it wasn't an accident that we invited them all today. But in any case, normally that would cost about $1,300. You can get a Summit Special only pricing at $8.99. Not only does that include all three of the add-ons, that's going to include 2 years of Stocks and Commodities magazine, 3 months of Metastock DC, the boot camp that I'm going to run on September 21st, and also an Unleash the Power of Metastock course. It kind of goes through all of the tools, and you can study on your own. So they are a little bit less busy now. If you tried to call earlier and were waiting, now's a good time, 800-882-3040, or you can visit us online at metastock.com/saleschat. And I do want to shout out to our sponsor today, Stocks and Commodities Magazine, 17,000, just a great magazine. If you're not a subscriber, you should definitely do the free copy. And again, if you buy any of our offers today, you're going to get at least 5 months of Stocks and Commodities, totally free of charge. If you spend $300 or more, you're going to get a 2-year subscription. So it might start to sound like a bit of a broken record, but they've been great partners for us, and really appreciate them. Metastock in itself, of course, that's our company. We've won 25 years in a row. We're offering those extended trials at metastock.com/trader summit 3 for 1.